Okay, everyone, welcome to another week ahead video, guys. Let's jump straight into it. Now, this past week, the main highlight, of course, was that Jackson Hole Symposium that we have coming out, where the Fed made a very fundamental shift in the way that they approach two things, namely inflation and employment. In terms of inflation, the Fed will now target an average inflation of 2% over time instead of having that hard target set at 2%. And that means that the Fed will be more tolerant of inflation running above 2% for a period of time. Now, why all this fuss about allowing inflation to run hot? Well, if we take a look at this chart, we can see core PCE, which is the Fed's preferred measure of inflation, hasn't really had any meaningful moves above that 2% level for over a decade. Now, even though they had massive amounts of stimulus programs before this one, none of them were able to actually push inflation up above that 2% target. Now, the new average inflation targeting will allow the Fed to hold back on hiking rates at the first sign of inflation, even if we get above that 2% level. Now, they also decided not to provide any clear time horizon for how long they would allow it to run hot, and also didn't provide any strict range that they are looking at. Most probably the most interesting twist that majority of market participants haven't yet anchored on is the change in their framework regarding employment. So even though both stable inflation and maximum employment form part of the Fed's dual mandate, one can argue that inflation was always the most important one of the two. However, with the new framework, it seems that maximum employment will be the most important aspect for the Fed, and the bank will be more focused about making policy decisions about shortfalls in unemployment, and they will be less worried about inflation running hot. Now, this is very significant for the bank and essentially means that the bank will be able to keep rates lower for much longer, as they will now tolerate inflation to run above 2%, and at the same time they can justify not moving on rates even if they are above 2% if they deem that the labor market isn't where they want it to be. So to sum it up, the Fed has basically just bought themselves flexibility to infinity, as they will no longer be bound by that 2% level, and they will no longer have to worry about running the labor market too hot either, as the Fed admitted that record low levels of unemployment has not fostered runaway inflation as the Phillips curve would suggest. Now, what does all of this mean for us as traders? It means that the stage is set for the dollar to continue its medium-term bearish trend, as the prospect of zero-bound rates and possibly higher inflation means the dollar won't gain any yield attractiveness anytime soon. It also means that US labor market data just got a lot more interesting going forward as well. In the week ahead, it will be a light week once again. The main focus, given the Fed's framework changes, will be on initial jobless claims as well as that NFP print. Recent NFP print has continued to surprise to the upside since we had that big drop of over 20 million going back in April. Now, the big surprises has shown just how difficult it's been for analysts and economists to really forecast data since the lockdowns and subsequent economic fallout from the pandemic. Now, looking at some of the upcoming expectations for next week, we can see markets are expecting another print of 1.4 million for headline NFP, and they're expecting the unemployment rate ticking down to 9.8 from a prior of 10.2. Now, as always, we need to make sure to evaluate the ADP national employment, as well as the ISM manufacturing employment index and the ISM services employment indexes going into the NFP report, as all three of these data points will feed into the overall NFP expectations. So what that means is a big surprise miss in all three of these data points will put a downside risk on NFP, whereas a big upside surprise in all three will put an upside risk to the NFP print. Now, seeing that the Fed's framework has shifted its focus away from inflation and towards employment, these numbers will be even more important than always, and any big deviations can be expected to impact markets across various asset classes, depending, of course, on the outcome. Now, this week's sentiment shifts and trade plan will be very straightforward, focusing on the NFP. Scenario 1, we have NFP headline coming in below the market's minimum expectation of 900K, and the unemployment rate edges above the market's maximum forecast of 10.1. If that happens, even though the markets don't expect the Fed to change policy anytime soon, a big unexpected drop in employment will enforce the idea that the Fed will need to keep rates very low for very long, especially with the changes recently made to that framework with employment in mind. Now, the trade plan, we would expect this scenario to see the US dollar sell off against a basket of euro, Aussie, pound. We can also expect some strength in precious metals like gold and silver. Now, we need to be careful for equities with this one, as worse data is bad from an economy point of view and should see equities moving lower. But if the event sparks hopes for more stimulus, of course, we could see a knee-jerk downside reaction followed by dip buyers shortly afterwards. So just be careful on that one. Scenario 2, NFP headline comes in above the market maximum expectation, of 2 million, and the unemployment rate edges down below the market's minimum forecast of 8.5. Now, even though the markets are not expecting the Fed to change policy, as we said, a big unexpected build in jobs could create some short-term upside from an already stretched downside position in the US dollar, as much better US data compared to recent slowing EU data could spark some position unwinding between those two, and that's definitely a risk we need to watch. Now, trade plan, if we do see that happen, we would expect US dollar strength against the basket of Euro, Aussie, Pound. We would expect precious metals, gold and silver to have weakness, and for equities, this should be a positive all round, as it will just feed into the hopes of a faster economic recovery.